All right, CA Inter students, let's get right into it. It's time to nail one of the most crucial and, let's be honest, sometimes confusing chapters you'll face, branch accounts. In this session, we are going to break down every single concept, walk through key ICAI-style problems, and make sure you walk away feeling totally confident. Let's do this.
So, picture this. You're in the exam hall. You've just spent 15 minutes on a branch accounts problem. Everything balances, the numbers look good, you've found a profit of $50,000, and you move on feeling great. But what if you missed one tiny little adjustment? An adjustment that means the real profit was $42,000 and you just threw away 4 easy marks. This happens all the time with something called unrealized profit in closing stock. Today, we make sure that never happens to you again.
Let's build our foundation. You can't build a strong building on a weak foundation, and it's the exact same thing with accounting. Getting these basics right is non-negotiable, because everything else we do today will build on these ideas.
So first things first, what's the difference between a branch and a department? Well, it all boils down to one word, location. A branch is in a different city, a different place. Think head office in Mumbai, branch in Chennai. A department, on the other hand, is just a division under the same roof, like the sales department and the finance department in that Mumbai office. And that one simple difference changes everything. With branches, you might need to reconcile accounts, or even deal with foreign currency. With departments, none of those issues. Now, for our purposes, we're focusing on what we call dependent branches. This just means the head office is the boss. It maintains all the books and calls all the shots. The entire challenge of this chapter, literally everything, comes down to how the head office sends goods to the branch. It can be done in 3 ways: at cost, at selling price, or at wholesale price. We're going to focus on the first 2 because that's where ICAI loves to test you. Okay, let's jump into our first big method for when goods are sent at cost. It's called the debtor's method. This is the most basic approach, perfect for smaller branches, and it's a great way to ease into the mechanics of branch accounting. Think of the branch account under this method as a simple black box. On the debit side, the left side, we put in everything the head office gives the branch: opening assets, goods, cash for expenses. On the credit side, the right side, we record everything the branch gives back: cash from sales, goods returned, and whatever assets are left at the end. The difference? Well, that balancing figure is your net profit or loss. Simple as that.
Okay, listen up. This is a huge exam tip. ICAI will almost never just give you all the numbers you need on a platter. They'll hide things. For example, they won't tell you the cash collected from debtors. They'll give you opening debtors and credit sales and expect you to figure it out. How? By preparing a memorandum branch debtors account as a working note. These aren't optional, folks. They carry marks, and they are absolutely essential to finding the missing pieces of the puzzle.
Let's see this in action with illustration 1A. See the final Nagpur branch account here? Debits on the left for everything put in, credits on the right for everything that came out. And you see that figure, cash from debtors, of $120,000? That didn't come from the question. That came from our working note. Once we plug that in, finding the balancing figure, our net profit of $15,000, was easy.
So the debtor's method is great for getting the bottom line, the net profit. But what if the head office wants more detail? What if they want to know the gross profit? For that, we need to open up that black box. So let's move on to the more detailed accounting methods. Under the stock and debtors method, instead of one black box account, we open up several accounts to get a clearer picture. We use a branch stock account to track our inventory and find the gross profit. We have a branch debtors account, a branch expenses account, and finally, a branch P&L account to bring it all together for the net profit. It's more work for sure, but it gives management way more control and insight.
Now, here is the absolute key takeaway. Look at the numbers from illustration 2. Whether we use the simple debtors method, the detailed stock and debtors method, or even a third one called the final accounts method, the final net profit is exactly the same, 9,400 rupees. This proves they're just different ways of slicing the same pie. The method you use in the exam is not your choice. It's dictated by the question. If they ask for gross profit, you have to use a detailed method.
All right, everyone, take a deep breath. We are now heading into the single most important, the most frequently tested, and honestly, the trickiest part of branch accounts. This is where we talk about what happens when goods are sent at selling price. This is where the real marks are. First, we need to be crystal clear on this one word, loading. What is it?
In simple terms, it's the profit margin the head office adds on before sending goods to the branch. If an item costs the HO 100 rupees and they send it to the branch with a price tag of 120, that extra 20 rupees is the loading. It's a paper profit. It's not real yet. The entire game from here on out is to find this loading everywhere it hides, in opening stock, in goods sent, in closing stock, and remove it.
Okay, so we know what loading is. Now, the big question is, how do we actually deal with it in our accounts? The good news is, the methods we already learned still apply. We just have to add in a few crucial new steps to handle this loading.
When you're using the detailed stock and debtors method, you'll need a special new account. It's called the branch adjustment account. The best way to think about this is as your loading removal headquarters. Every bit of loading you find gets processed through this account. Its only job is to strip out all that paper profit so we can see the real, actual gross profit.
Let's see this in practice with illustration 3A. Look at the branch adjustment account on the screen. On the credit side, we've put the loading from the opening stock and all the goods sent during the year. Then, on the debit side, we account for the loading on the closing stock. We call this the stock reserve. You see the balancing figure? That 39,000 rupees? That's our true gross profit after all the paper profit has been filtered out.
But what if the question asks for the simpler debtors method but with goods at selling price? We still have to remove the loading, but we do it right inside the main branch account itself. The logic is simple. First, record everything at its full invoice price. Then, for every item that has loading, you pass an opposite entry to cancel out that loading. So, things on the debit side like opening stock and goods sent, we pass a credit to remove their load. Closing stock is on the credit side, so we pass a debit to create its stock reserve. It's a critical process, and this is where mistakes are common.
And here's what that looks like. This is the solution to illustration 3B. You can clearly see the adjustment entries inside the main account. On the credit side, there's the loading removed from goods sent, and on the debit side, there's the stock reserve for the closing stock. Even though it all happens in one account, we still get to the right answer, a net profit of 16,250.
Take a look at illustration 4. The first thing you'll notice is that they give you data for 3 separate months and ask for the profit for the quarter. Don't let that throw you off. The trick is just to add up the relevant figures for all 3 months. And of course, you absolutely must prepare that memorandum branch debtors account as a working note to find your closing debtors. After that, it's the same process we just mastered for the debtors method at selling price. Now this is a 5-star classic ICAI trap. Look at illustration 5. The problem is, to prepare a trading account, you need the invoice price of the goods that were sold. But the question only gives you the final selling price. They tell you, goods are invoiced at cost plus 20%, but sold at cost plus 50%. So to find the invoice value of goods sold, you have to work backward from the sales value. You take the 12 lakh sales and multiply by 120 over 150. That conversion is the key to cracking this problem.
So as we wrap up, let's go over your final exam checklist. These are the things you need to burn into your memory. First, the second you read a branch question, ask cost or selling price. If it's selling price, your brain must immediately scream, remove the loading. Third, working notes are not optional, they are mandatory. Fourth, always look out for goods in transit. And last but definitely not least, do not forget the stock reserve on closing stock. It is the most common and painful way to lose marks.
Picture this. You open the paper and you see that the head office account in the branch's books has a credit balance, but the branch account in the head office's books has a totally different debit balance. Wait a minute, aren't they supposed to be perfect mirror images of each other? Yes, but they often aren't, and this single point is a massive trap where so many students needlessly lose easy marks. By the end of this session, you'll know exactly why this happens and how to fix it every single time. And here we go. Pay close attention because this is the place where marks are made or lost. ICAI loves this. The goods are sent at an invoice price, right? That's just the cost plus a profit margin, which we call loading. In this example, if the goods are sent at cost plus 25%, that means if cost is 100, the invoice price is 125. The loading part is 25. So the killer question is, how do you find the loading if you only have the invoice price? It's 25 divided by 125, which simplifies to 1/5. Please never, ever use 1/4. That's a fundamental error. It's always loading over the invoice price. You have to nail this calculation. So you've calculated that loading. What do you do with it? Well, its home is the branch adjustment account. The only job of this account is to strip out that profit element so we can find the true gross profit. So on the credit side, you put the loading from the opening stock and the goods sent. On the debit side, you reverse the loading on any returns and on the closing stock. And that final balancing figure on this account? Boom, that's your gross profit. It's such a neat way to separate the stock movement from the actual profit calculation. Okay, deep breath. We've handled dependent branches. Now it's time to level up to the independent branch challenge. These are the bigger branches, the ones that are basically running their own show and are large enough to manage their own complete set of accounts. So what exactly makes a branch independent? Well, for starters, it means they're doing their own accounting, from top to bottom. They maintain their own double entry system, prepare their own trial balance, and even their own profit and loss account. The really crucial link between them and the HO are two special accounts. In the branch's books, there's a head office account, and in the HO's books, there's a branch account. And in a perfect world, these two accounts are supposed to be perfect mirror images of each other, equal and opposite balances. But as you know, accounting exams are rarely set in a perfect world. So we get to the absolute heart of the independent branch problem: reconciliation. Because at the end of the year, those two mirror accounts almost never match, and your job is to figure out exactly why and how to fix them. So when the numbers don't match, here are the four usual suspects. First, you've got goods in transit. The HO sent the goods, but the branch hasn't received them by the year end. Second, cash in transit. Same idea, but with money. Third, direct transactions. Maybe the head office collected cash from one of the branch's customers, but forgot to tell the branch. And finally, unrecorded allocations, like the HO charging the branch for its share of the head office's rent. These are the classic adjustments you should be hunting for in every single problem. So who actually makes the adjustment entry? The rule is so simple but so powerful. Just remember this: the entry is always passed in the books of the party that is unaware of the transaction. Think about it. If goods are in transit, the head office knows it sent them, right? The branch is the one in the dark, so the branch has to pass the entry. If cash is in transit from the branch to the HO, the branch knows it sent the money. The head office is the one that doesn't know it's coming yet, so the head office passes the entry. If you understand this logic, you'll never get it wrong. All right, so you've done the hard work, the accounts are reconciled, and everything matches up. What's the final step? Well, now we have to actually incorporate the branch's results into the head office's books, so we can create one set of financial statements for the whole company. Let's see how that's done. There are basically two ways to bring the branch's numbers into the main company books. The first way is the abridged or simple method. Here, the branch just sends over one number, its final net profit or loss. That's it. The second way is the detailed method. This is more involved. The branch actually closes out and transfers every single one of its revenue accounts, sales, wages, rent, everything, to the head office account. The HO then combines all of those with its own numbers to create one single consolidated profit and loss account for the entire company. This detailed method is what you need if the goal is to prepare a single consolidated balance sheet. Oh, and a quick but super important point that often trips people up: inter-branch transactions. What happens if, say, the Mumbai branch pays an expense for the Chennai branch? Well, in the accounting books, the two branches never talk to each other directly. Everything is always routed through the head office. Mumbai will debit the head office, and Chennai will credit the head office. The head office acts like a central clearinghouse, debiting the Chennai branch and crediting the Mumbai branch. Don't forget that.
Getting these core adjustments right isn't optional. Seriously, these are the easy marks that so many students lose just because of silly mistakes. We are going to lock these down right here, right now. All right, these are the four entries you just have to know. No excuses. Step 1, that's the answer to our very first question. When goods are in transit, the branch must record them. You debit goods in transit and credit the head office account. Simple. For steps 2 and 3, the logic is exactly the same. Any expense HO pays for the branch or any depreciation on branch assets gets debited to the expense or depreciation account in the branch's books. The credit always goes to the head office account. And finally, step 4, rectification. What if the branch accidentally pays for something for the HO? Well, it debits the head office account, basically saying, "Hey HO, you owe us this money back." If you master these 4, you've got your foundation set.
So what happens when branches start dealing with each other? Here's the golden rule, and you got to remember this. Branches never talk to each other directly in the books. Every single transaction gets routed through the head office. So at year end, the HO just passes one single consolidation entry to clean it all up. As you can see right here, after netting everything out, Mumbai and Chennai are debited because they effectively owe the HO, and Delhi and Kolkata are credited because the HO effectively owes them. This one entry fixes the whole inter-branch mess.
So here's our puzzle. This is the branch account in the head office's books. We can see the opening assets, the goods sent, but notice those two big question marks. We need to find the net profit.
But to find that, we first have to figure out how much cash the branch actually sent back to the head office. And this is where memorandum accounts become your best friend.
And this is exactly how we solve it. We build these little rough T accounts for stock, debtors, and cash. We just plug in all the numbers we know. The balancing figure in the stock account, that's our closing stock. The one from the debtors account, closing debtors. But the real magic happens in the cash account. You put in the opening cash, add all the cash that came in from sales, subtract the expenses, and what's left? The final balancing figure has to be the cash sent to the head office. And there it is, $11,700. We've found our missing piece.
Now, instead of memorizing a dozen journal entries, just think of incorporation like this. It's a 5-step merge. The head office opens temporary branch trading and branch P&L accounts. It then just pulls in all the items from the branch's accounts, sales, expenses, everything, step by step. The final net profit gets moved to the HO's main P&L. And once the profit is in, the last step is to just pull all the branch's assets and liabilities onto the HO's balance sheet. The key check for your exam? The branch account in the HO's books must perfectly cancel out the head office account in the branch's books.
It's time to face the final boss of branch accounting, foreign branches. Here we take everything we've learned and add one more layer of complexity: different currencies. All the principles are the same, but before we can do anything, we have to translate the foreign branch's trial balance into the head office's home currency, and we have to do it by following the rules of Accounting Standard 11. Now, before you even think about converting a single dollar or euro, the absolute most critical first step is to classify the branch. Is it an integral foreign operation, an IFO, which is basically just an extension of the head office, or is it a non-integral foreign operation, an NFO, which operates much more independently? Your answer to this one question dictates every single translation rule you're about to use. If you get this classification wrong, the entire problem will be wrong. It's that important. This slide right here is your cheat sheet for AS11. Let's break it down. For an IFO, you translate non-monetary items like fixed assets at the historical rate, the exchange rate on the day they were bought. But for an NFO, things are simpler. You use the closing rate for all assets and liabilities. But here it is, the biggest point of difference, the part that ICAI loves to test. The final exchange difference for an IFO goes straight to the profit and loss account. For an NFO, it does not go to P&L. It goes to a special reserve account called the Foreign Currency Translation Reserve. This is the detail where you can either gain a whole lot of marks or lose them.
Okay, this slide is everything. You absolutely have to memorize these rules. Fixed assets, they use the historical rate from the day you bought them. Revenue and expense items, they happen all year, so we use the average rate. Monetary items, things like cash, debtors, creditors, they're valued at the rate on the balance sheet date, so we use the closing rate. And here's the classic trap. The head office account is never converted. You just take the actual rupee figure from the head office's own books. Getting these rates right is 90% of the work.
So what happens if a branch changes from, say, an NFO to an IFO? It can happen. Well, from the date of that change, you start applying the new rules. But, and this is a very tricky point, that balance you had sitting in the foreign currency translation reserve from when it was an NFO, you freeze it. You leave it alone, you do not touch it or transfer it to the P&L. It just sits there on the balance sheet until the entire foreign branch is eventually sold off or closed down. It's a very specific rule, so make a mental note of it.
So what happens when you apply all those different rates? Well, your trail balance won't tally. Don't panic, that difference is expected. We plug it in as a balancing figure called difference in exchange. It's not an error, it's the real financial impact of the currency moving around. You then take this exchange difference and transfer it over to the P&L account before you calculate the final net profit. Do not forget this step, it's a critical mark. Okay, let's switch gears completely. Time to put this knowledge to the test with a rapid-fire round covering a bunch of different accounting standards. I'll throw out the scenario, you try to figure out the answer in your head before I explain it. Ready? Let's go.
First up, AS9. Revenue is recognized when risks and rewards transfer. Since the railways inspect the goods at the factory, that's the point of transfer, not when it's dispatched. For inventory under AS2, normal wastage is just part of the cost of the good units. But that abnormal waste, that extra 50 MT, it's an expense. It goes straight to the P&L.
Case 2, you have to split the revenue. You deliver the AC, so you recognize that part now, but you haven't done the installation yet, so you defer that bit of revenue to next year. And because of the warranty, AS29 says you must create a provision. Case 3, AS16 is super clear on this. You can only capitalize borrowing costs when active work is happening. That 3-month stop, That means you stop capitalizing. Interest for those 3 months has to hit the P&L.
AS3 alert. For a finance company, earning interest is their day job, so it's an operating activity. For any other company, it would be investing. The loan to a subsidiary is a classic related party transaction, so it needs disclosure under AS18. And for AS12, the treatment of grants depends on why you got them. Free land, record it at a nominal value. A grant for the factory itself, that's a promoter's contribution, so it goes to capital reserve. A grant for a specific machine, that's deferred income, and you recognize it in the P&L over the machine's life.
Last two. In case 6, AS10 says you record the machine at its cash price, which is 10 lakhs. The extra 30,000 is interest. And your cash flow statement, the part you paid for the asset, the 4 lakhs, is investing. But the interest you're paying on the loan is a financing activity. In case 7, the travel company is a principal, not an agent, because it buys the tickets and takes the risk. That means it recognizes revenue on a gross basis. And for that forward contract, prudence kicks in. You must recognize expected losses, but you ignore any unrealized gains.
And that brings us to the end. So, what's the big takeaway from all this? It's that knowing the rule is only half the job. The real skill, what ICA is really testing, is whether you can read a complicated story problem, pull out the key facts, and apply the right rule. That's the game.
So, as you head into your final revision, I want you to ask yourself this one question. Which part of what we just covered made you a little nervous? Was it the foreign exchange rates, the loading adjustments, or maybe one of the AS scenarios? Find that one weak link in your chain and focus your energy there. That's how you turn a pass into a distinction. Good luck.